welcome to the next session. I hope you had a great time listening to Rick Wagoner, the former CEO of General Motors. Moving forward, we have an exciting session lined up for you. Please meet our host for this session, Brian Stack from ATI, who's going to explain you the financial statements and make it as easy as possible. It's your guide to read and understand the key metrics. So super excited for this session and hope you guys take a lot of insightful insights. Brian, over to you.
Awesome. Thank you very much. And hello, everyone. And I am happy to have you here simply because this is a topic that unfortunately a lot of business owners in our world, in our industry, in automotive repair, really don't truly understand nor truly understand the value. But problem is, I have a lot of information that needs to be seen or read by you. But with the hour's time we have, I'm going to cover it a little quick. So in chat, you should have a copy or a PDF version of this, because my objective is not to teach you every single thing about a P&L or a balance sheet. My objective really is to help you get a better understanding and have better conversation with your CPA. Now, really what my objective for this session is, I'm hoping that you can understand the primary financial statements, and I'm picking on the two biggies. I'm picking on an income statement, P&L, and the balance sheet. And there's entirely two different purposes. To be able to identify the purpose and the key component of each financial statement, learn how to extract critical insights about a business financial health. Now, unfortunately, over the years, I've met a lot that felt the checkbook was the best way as a barometer for profitability and health of a business. And that is one way of looking at it. But unfortunately, bankers, lenders, a business broker, or a potential buyer in business use these two documents, the P&L and the balance sheet, to test the business's financial health and develop some basic analytical skills to spot trends or red flags. That's the big reason I want to make sure you have a copy of my presentation. But I'm hoping you guys walk away with the ability to recognize and interpret the structure of financial statements. What do they mean? What are they going to tell you, and why do you care? A checklist of essential questions to ask when reviewing financial statements. A framework for connecting financial data to operational decisions. And really enhance your confidence engaging with CPAs. Because like I said, not a lot truly understand all these, but a better understanding of what they're trying to tell you will put you in a position to not be a CPA. I'm not. But it'll help you understand what they're trying to tell you and better discussion. So I hope you guys are okay with all of that. Now, financial documents. Why do you care? Financial statements are written records that convey the business activities and financial performance of a company. And these statements are often audited, so they got to be clean, they got to be right. And I'm talking about the two, which is P&L and a balance sheet. I'm a little confused about the reason for P&L because you can't have both, but the profit or loss has a purpose and your balance sheet has a purpose. And again, why do you care about your financial documents? I am a big believer, and I've been working with business owners in auto repair for 25 years. I've been in the auto industry for well over 40 years. And unfortunately, not everybody does, but I'm a believer that you need to be intimate with your business numbers and intimate with your financial documents, and understand that these documents are crucial for a business owner because they provide insight to the financial health and performance of the business. And here's the key reasons why you care. Informed decision making. When is it time to go and grow or invest? A financial health assessment for the business, and understanding metrics like profitability, liquidity, and solvency enables the owner to identify strengths and weaknesses in the business. Compliance and reporting. Yeah, these are all regulated. There's something out there called GAAP, Generally Accepted Accounting Principles, that all your documents and your CPA There's legal compliance, and that's what they have to follow. For any of you that may be thinking about either bringing on an investor, ultimately sell, because there is going to be a day that every business owner is going to want to get their equity out of a business, or there may be a time that owner wants to buy the property, wants to buy the dirt. Unfortunately, these are the kind of things that, well, fortunately, it's what attracts. And potential investors and lenders or partners often require access to your financial documents. And a business owner who understands these can effectively communicate the company's value. So, from these two documents, a value of business and your ability to get financed for capital expenses depend on these documents. Strategic planning, we kind of talked about that a little bit, but helping set forecast future financial performance with things like retained earnings, with liquidity in the business, and set realistic goals and strategies for growth and sustainability. And I know I got one or two more, but risk management and succession planning are the other two that really are, why do you need to know? But in summary, a deep understanding of financial documents empowers a business owner to better manage the business. So, with that, let's get into our first one. And our first one is a profit or loss statement. Now, what does a P&L tell you? A P&L represents a period of time, a month, a quarter, or a year. Also, as far as month to date or year to date type. So a P&L, unlike a balance sheet, represents a period of time. And there's a couple things a P&L is going to tell you, but the biggest thing is your business profitable? Are your pricing strategies effective? And again, your revenue, your sales, and costs determine profit margins. And I don't care whether that's parts margins, labor margins, sublet margins, or so on, or overall gross profit and net. So a P&L really tells you, are your business practices profitable? They do not do anything to tell you about the cash or cash flow in your business. These are determined by a balance sheet and also even what was called a statement of cash flow. And the next thing a P&L is going to tell you, and I'm going to give you an example of this. Are you generating enough sales to keep fixed expenses in check? So to me, a P&L, are my business practices profitable? And am I generating enough sales to be able to keep my expenses in check? So I am a believer of using a P&L as a diagnostic tool for your business. What does that mean? Now, at ATI, I teach a profit model. It's not important that you know this model. It's important that you have one. And I hope you have some type of a profit model that you're chasing to align your business to measure performance of your business and use as a barometer of what's a good day, month, year look like in your world. But the model, and I'm going to show you on a P&L what this means. And from 100% of sales, we look at parts cost. For this exercise, it's 20% of sales. We look at labor cost, which is the technician wages, all tax and benefit loads, so fully burdened as a barometer compared to sales. And then we have our sales costs for support roles. We will call that service advisors, customer service reps. And as business gets bigger, larger, bigger sales volumes, this could include things like parts managers or any expediters or estimators that you might use for support for your front counter. Which, looking at my numbers, the model that I teach would leave 50% gross profit margin left. Now, again, breaking down this model is going to take a lot longer than the time that we really have. But with this, how do you use a P&L as a diagnostic tool for your business. Now, I have a fake P&L. The numbers are real. The names have been changed to protect the innocent. And I am a believer that a P&L should have a specific structure. Now, what to me this might look like. First, I am a believer that a P&L, and I don't have to be right here. I just believe that with just total income, just this lot, total revenue, total income, 1.8 million, really doesn't do you the justice that you need to manage, measure, and diagnose the business. So I am a believer that all of your profit centers, parts sales, labor sales, sublet sales, towing sales, tire sales, whatever else you might have in your business, should be broken out individually. Now, also with that, cost of goods. And there's different beliefs on what should be included in cost of goods. Now, I have many, or have met many, that ultimately changed, that looked at, even if they had this broken out, total cost or total income, and the only cost of goods sold they had were parts. And they called that gross profit. Now, I don't believe in that. I believe that your costs of goods sold are more than just parts. For every profit center of revenue, I am a believer that we have a cost of part, or a cost of good rather. So for part sales, you have parts cost. For part sales, you also have a job supply cost. And some might even have supplies as a revenue broken out. If I have labor sales, I should have my labor cost separately. Now with this, labor cost loaded. This called loaded here. This is payroll taxes, workers' compensation, any paid time off, any uniforms, or I said vacations, but any training. If it cost you money to put that individual on the floor, we would highly recommend including that into a labor cost, and I'll share that with you why in a second. But now also sales cost. I mentioned when I look at the model over here, 10%, not engraved in stone, it's flexible, and it's going to be a little bit different for every one of you. But we believe in breaking that out separately and giving the full tax and benefit load on that one, so you know exactly what it's costing you. Now, parts sales, parts costs lead to a parts margin. Labor sales minus labor costs lead to a labor margin, or a percentage of sales to reflect to a model. A sales cost is just your barometer of what are your sales really costing you. And only you're the only one that has the right to say, is it high, is it low, and what is it really bringing you in return? Yes, I also look at sales, what does it cost? But I also look at how much does your freedom cost, if that makes any sense. Deep down, I do say some people pay more to buy free time from the shop. And there's absolutely nothing wrong with that, but that's up to you. But by bringing labor cost and all the benefits, and bringing sales cost and all the benefits up with parts, it will truly give you a true gross profit margin for your business. Now, how do we look at this? How do I look at this? To me, this is your real revenue, not here. This is sales. This is your money to spend because everything else is already taken care of, or everything else is already accounted for. This money has to cover two things. It's got to cover all your fixed and operating expenses, and it's got to cover any return on investment for you as the business owner, or reinvestments back into the business, or payments for capital expenses, which a lot of people call that net profit. So point one, yes, a P&L represents a period of time, and this was a full year. Break out all income, break out all revenue centers with all applicable costs to get a true profit margin, a gross profit margin. And you can see here also, by having this percentage of income turned on, This is what allows this to become a diagnostic tool for pricing efficiency and profitability of your business. And if we start at the top, a profit model that I share, and even the old school profit model, which 2 times parts and techs get 50% of the labor, believe it or not, that was a model, but it required part sales and labor sales. So just looking at this real quick, it'll give you a good snapshot of what your part labor ratio looks like. But also when it comes to pricing efficiency compared to the profit model, I did say from total sales, your parts costs shouldn't be any taller than 20% based on the model that I work with. And as you can see very quickly, with this percentage of income turned on, 18 plus 2 is 20%. So at a snapshot, I'm holding good profit margin and I'm meeting my profit model. Second, we look at labor cost. I did say labor cost at 20% of sales when it came to the profit model. When I have this percentage of income turned on, using this as a diagnostic tool, I see very, very quickly that I'm in line with my profit model. And then my sales cost, and yes, this is a real number. This is 8% of my sales. Like I said, this is a barometer of what does it cost you, but this is also telling me that I'm reaching a point in sales that I know I have some leeway when it comes to bringing on support for a service writer. Let's call that a CSR, customer service representative, or somebody you're about to start to develop and or train. So with this, break out all revenue, break out all cost, turn percentage of income, so I can see very, very quickly as a diagnostic tool, how am I doing compared to a profit model? Now, with this also, as I said, am I generating enough sales to keep my fixed and operating expenses in check? Now, what I didn't share with you in the model, I said a 50% gross profit margin, but I did say that's got to cover fixed and operating expenses. And am I selling enough in sales to keep my expenses in check? For this exercise, I'm looking at my expenses at 31% of my sales. And to me, 30 to 35% is good, depending what you have in here. And that's a whole different other discussion. But this right here would quickly tell me that I'm selling enough to keep my expenses in check, which in turn, gross profit dollars minus total expenses definitely demonstrates the net income from the business. Now, again, this kind of money is to allow a business owner to get a return on their investment, as well as invest back into the business. And yes, this is a profit model that I work with, and I work with business owners for years. But when the P&L is structured right, or structured the way we would recommend, and percentage of income is turned on, not only will it help a business owner understand what is a P&L trying to tell you, but it becomes a great diagnostic tool. Now, here's something else I wanted to share with you out of this, because I am a believer that every business owner needs to know this. But I had also mentioned that the P&L is part of business valuation. And here's how this works. And I'm not sure how many of you are familiar with a term called EBITDA. I'd love you to be, and hopefully from this presentation or my materials that I parked in chat, if you don't know, please spend a little bit of time learning what EBITDA is, and then why do you care? And EBITDA, the initials, is an acronym for earnings before interest, taxes, depreciation, and amortization. This, it is a valuable metric to value a business, but here's how it applies. Now, here's that same chart of accounts on expenses that we just looked at. And we looked at that bottom line of the business at 371, which is actually the earnings from the business. And the before means they've already deducted things like interest expense, taxes, depreciation, and amortization as a tax minimization strategy. And you have every right to do that, and your CPA will do that for you. But when looking to prove cash flow out of a business, they add back 4 items. So the E is earnings, which is bottom line, and an officer's salary. What are you taking out of the business for your role as a business manager, owner? But then they add back things like interest expense. That's your I. And this is interest paid on credit cards, on any loans of the business. Then they add back any corporate taxes. This is not sales tax. This is not payroll tax. Payroll tax is brought up top with your cost of labor. Then you have depreciation and amortization. Now, on a P&L, a lot of you will have depreciation. But on accrual accounting, it's only going to show up on the quarterlies and the year end. For accrual-based accounting, cash-based accounting, it shows up quarterly and annually, but on accrual-based, it should be every month. But not everybody has amortization. Depreciation is a depreciation value over the life expectancy of tangible assets, things you can touch, cars, furniture, equipment. Or amortization is the write-off or depreciation schedule of intangible. So with that, sorry guys, this is EBITDA. And I am a big believer that you should know this, just so you can see where you stand as far as business. Now, I'm hoping you can grab my presentation out of chat. When you get yourself some quiet time, pull up 2024 P&L just to see what this looks like. Now, again, how do they use this as part of a valuation process? They look at the total EBITDA value. And for this exercise, the EBITDA value of this repair facility was $571,617. Now, when it comes to EBITDA benchmarks and multipliers on how they value, here's a couple, just some FYI. EBITDA margins range anywhere from 11.5% to 26%. And this is most recent as of 2024. And here it talks about the data indicates that the fourth quarter of 2024, the automotive aftermarket had an average of 11.5. Or I'm sorry, aftermarket had an EBITDA margin of 11.5, slightly above the average. And that's where I got that from. But very efficient shops. And I use the term top, and take that for what you will, but a good barometer of a very healthy, pricing efficient shop is around 26%, as I said up here in this range. So what this means, that EBITDA value that we just talked on the previous page from that P&L, earnings before interest, taxes, depreciation, amortization, that's the EBITDA value. And then a business valuation is going to determine what type of a multiple to hit that EBITDA with. So in other words, I had 571,000 EBITDA value here. To see what your business might be worth, you're going to determine your EBITDA value. And then I want you to hit it with a multiplier and anywhere in between here. And to be brutally honest, to give yourself a good number, because multiples have been good for our industry over the last couple of years, which is great. Just use a number of like 3 to 3.5 to get a value for your business. I do believe everybody should know. And there's lots of different ways. I'm teaching you enough just to make you dangerous with it. But the reality is EBITDA value times a multiplier create the value of a business. So those are the kind of things a P&L are going to be able to tell you. But that EBITDA, a performance assessment, benchmarking compared to industry standards, and that profit model I shared with you is a great model to start, or a great model to chase, a great model to shoot for. EBITDA can help you with strategic planning. Oh, and remember what I said. provide a clear picture of your business's financial health. Financing, of course, bankers and lenders often look at EBITDA when assessing loan eligibility. So all in all, by focusing on EBITDA, automotive repair business owners can get a clear understand their operational profitability. So I hope P&L makes better sense. It's a measurement of time, month, quarter, year. It will test. Oh, it's a great diagnostic tool comparing to a profit model. And the things a P&L will tell you, are your business practices profitable? Are you selling enough to keep fixed and operating expenses in check? And EBITDA value is going to determine what a business might be worth. So I hope you learned something with that or gain something from that and take advantage of that when we get finished. But now let's talk about the balance sheet, because the balance sheet really serves an entirely different purpose. And balance sheet, I want to think, is probably a little bit more confusing just because it's got a lot of numbers. But one big component from a balance sheet that really means a lot to a lot of people is called ratios. But a balance sheet, financial position assessment, there's your test of your financial health. Liquidity analysis. Should somebody lend you money, can you cover your debt? Debt management, the amount of debt a company carries and its capacity to take on additional, will help make better investment decisions because it helps the owner make formed investment decisions based on retained earnings, assets, free cash flow, and stuff like that. And again, I mentioned the business valuation. And as a class that I love doing, I do teach a class on succession planning. And I hate to say this, but most people aren't aware of how they value a business. And that's where they actually learn where do they got to be to get the kind of money or get that equity they need out of their business. And I'm not going to read all the others because it's long, but benchmarking and performance monitoring, risk identification. So this right there, and I highlighted the important components of these. And again, it's in your PDF, but let's really get down and dirty. But the balance sheet is a fundamental financial document that provides essential information for managing the business's financial health. That is exactly why you care about a balance sheet. And again, I'm just going to share enough with you to help you ask better questions. And I hope that part makes sense. Now, a balance sheet provides a snapshot of a company's financial position at a specific point. Now, like I said, a P&L measures month, quarter, year. A balance sheet is at a specific point, such as April 11th of 2025. So the balance sheet runs as of a date, and it's accumulative to everything you've done in business. And it shows what a company owns, what it owes, net worth. And this one right here, I'd love for you to test on yours, because there's where I see people's faces that some love it, some not so much. And again, remember, when you run a balance sheet, you could probably run it right out of your QuickBooks. It's going to ask at a specific day, what day and year in the business. Now, assets, I do believe you know this, so I'm not going to read a whole lot into this, but assets comprise all the physical resources that your company can put to work. And that's your cash and financial instruments. That is your inventory. That is land, building, and equipment. And believe it or not, accounts receivables count as an asset. Problem with that is when days sales outstanding, when that receivables reaches over 90 days, banks, business brokers, they don't include that anymore. So just a note to self, if you have a receivable, I know you're going to have it, work on collecting that. But those are assets. You also have liabilities, and these are debts to suppliers or creditors. And these are funds owed to suppliers known as accounts payable. Now, my heart says you knew that and you understand that. But something I really want you to look at, and here's the only place you're really going to find this, is a balance sheet. In a balance sheet, it lists assets, short or current assets, long-term assets. It's going to list liabilities, and as far as the short-term or total liabilities. But there's another item on that balance sheet that I'd love you to look at. It's owner's equity. And it's what's left after you subtract total liabilities from assets. So the fundamental equation is assets minus liabilities equals owner's equity. So in other words, if you took every one of your assets, sold it or converted it to cash, and you paid off all of your liabilities, all the debt in the business, that's what your hard work has been worth. I hate to put it that way, but that's the best explanation I could say of that. So I'm hoping some of you were thinking I need to take Stasha's presentation and get home, run a balance sheet, and see where I stand. I get all kinds of expressions when I share this in a class. But here's what I think this is important for you to do. Comparing owner's equity from one period to the next. As in pool, maybe looking at a balance sheet from 12/31/2020, then 12/31/2021, then and so on, all the way through 12/31/2024. Hopefully, your owner's equity is constantly growing. And this shows you how your investment, your cash exchange getting into the business, how it's doing. And I hope that's just moving north. Now, a balance sheet, the layout, it shows assets on one side of the ledger and liabilities and equity on the other, or top or bottom. Depends if it's portrait or landscape view. But assets on the top or the left, liabilities and equity on the other. Now, it's called a balance sheet because the two sides must balance. And that's puzzled me for a long time, but according to regulation, it is. And I just like to say it's a posi traction rear end. Nobody knows how it works. It just does. For any of you Joe Dirt fans, that's what a balance sheet. Now, the balance sheet describes not only how much a company has invested in assets, but also the kind of assets. What portion comes from creditors, liabilities, what portion comes from owner's equity. And again, as I had mentioned before, this is best when compared to previous periods. Now, we're going to talk about ratios in a minute. And some people look at debt as bad. But when it comes to this, when it comes to business growth, there is a time, do I use my cash or do I finance? And there's lots of different things going there. Please talk to your CPA. But there are times, especially when needing or leaving cash available for other opportunities you might want to finance. But also from the negative side, if somebody's seeing low cash, low retained earnings in a business because you're spending all your cash, somebody might think you're a little too conservative. So to have some debt is good. And there are times to use financing or debt compared to your cash, but your CPA can help you with it. And just because of the essence of time, I had mentioned about different types of assets. You got current assets, which are typically things that can be converted into cash in a year. And then you have fixed assets like property, furniture, and equipment. Now, depreciation, I know you guys are familiar with this, and your CPA has every right, but according to the rules, a CPA must charge a portion of the cost against revenue over estimated useful life. But your CPA has every right to design what that looks like. But depreciation is on a balance sheet. Not sure how many of you care about this one, but if you buy a business, if you buy a shop, anything like goodwill, which goodwill is the difference between the sale price and value and asset valuation, that gets included as an asset. And then you got liabilities. I'm just checking my time here. You have current liabilities, typically paid within a year, short-term loans, accrued salaries. accrued income that stay in the balance sheet, and any accounts payable are current liabilities. Now, also, this gets a little confusing too, because a mortgage or equipment, if it has a payment term longer than a year, those payments that happen within that 12-month window are considered a current liability or any other revolving lines of credit. But the long-term liabilities, again, are bonds and mortgages. And again, the debts that are contractually obligated to be paid over more than a year. Like I had mentioned about with the short term here, payments on long-term liabilities count as a current liability. The remainder ends up over here at long term. And I hope that makes sense at all. And if anybody has a question, please feel free to throw that in chat. Now, we kind of spoke about this a little bit, and I'm hoping you're looking forward to getting to grabbing a balance sheet and take a look or see what this really looks like. But owner's equity is an important item that you'd find in the balance sheet, because this tells you, has all this been well worth doing? And I hope you care. But what it includes are retained earnings, any contributed capital, which is money that you've paid into the business, or any paid in capital, something that's received in exchange for sale or shares for any of you that have taken on an investor or a partner. Retained earnings is what it is. And I've always wondered why people do that, but it makes a lot of sense from a balance sheet perspective. This is just money that the business made at a bottom line, net operating profit that was left in the business, as in the owner did not pull it out. And there's benefits to leaving it in the business. It will prove cash flow. It will prove financial health, and it will mean a lot when it comes to valuing a business, because people don't want to buy a business and people don't want to lend money to a business if the business owner is constantly pulling all the cash. So hopefully we keep some retained earnings in the business, but it really is about the value the owner has left in the business. And again, banks and investors want to see it. Now, again, with this, I've probably said this more than once, but a balance sheet is best used as a comparison over a previous year or same time previous year. And whenever looking for the money, and I've done this exercise many times with a business owner, when your P&L shows that that business made money and you don't see it in your checkbook, a balance sheet is where you're going to find that. And there's three things I want you to look at. Number one, how much did you take out? And depend on how your corporation's set up, LLC, sole proprietor, S Corp, C Corp, is going to dictate how much and how you take it. But double check with your CPA. But one of the items you're going to want to look for, how much did you take out of the bid? Two, did any of your assets go up? Did equipment go up? Did furniture go up? Did vehicles go up? Did your bank accounts go up? And liabilities went down. Paid off some debt. So when your P&L shows profitable and your checkbook doesn't have the money, here's where you need to look. And I hope that's worth a couple minutes of your life to be able to do that, because I know way too many that have even hit me with the question, my business is profitable, where's my money? It's in one of these three categories. Now, to me, here is a great way of really looking at the financial health of your business and in comparison to industry standards, automotive repair, because I got some numbers here and I don't want to go too fast, but I just definitely want to make sure I get this covered, because between using the P&L as a better diagnostic tool to a model and understanding what ratios are and where they come from are probably the two most important parts about this. But when it comes to ratios, you've got four types. You have a liquidity ratio. And again, this is the most important to a bank or a lender. And it's about, does the company have enough cash to pay its bills? Then you have profitability ratios, which is number two. And this is about how well does the company generate profits, pricing strategies, use of assets. Then you have leverage ratios, and this is about how extensive is the company using debt. And like I said, there's nothing wrong with using debt to continue to go and grow your business. And then you have efficiency ratio. And this is about how efficient does the company use its assets and its money. So here, I know I'm going to cover this a little quick. Take some notes or grab that presentation and really start talking to your CPA or ask, where do you fit? Because ratios shine light on three potential areas of business: liquidity, a competitive advantage or disadvantage. And when it comes to liquidity, current and quick ratios tell whether a business can pay its debt. And this determines whether you'll get financed or not. But if you can't easily do so, it might give you some thoughts on where you might want to start cutting some costs. Again, then you have competitive advantage or disadvantage. And this is comparing to industry average, often reveal financial strengths and weaknesses. And here's one example, but I'm going to share you several. And I do have a couple industry averages in here because that's all I work with. It's in automotive repair is all I know. And then it'll help you identify performance trends, like a return on sales. If return on sales is shrinking, cost of sales are growing relative to sales, again, you should be looking at cuts. So this is the kind of stuff that ratios will tell you. And there are some examples of some cuts. Shop all expenses, and you can bet I'm a believer in expense audits. Expenses are not a set it and forget it. I do recommend quarterly, yourself or a bookkeeper, look at the expenses, determine which ones are shoppable, and see if you can do better. Look at any waste, any non-essential stuff, but do not cut out production capability. And here also with performance trends, we had talked about return on sales, but a growing return on assets or a return on sales is really the best time to expand or add new equipment. And here's a definition of these above. So if we know my return on sales is going up, my return on assets, here's a time that is the most comfortable time to expect to spend money. And I hope your CPA. But let's look at some liquidity ratios. And I know I'm going to cover this quick, but you have it in the presentation. But this measures risk by emphasizing the company's ability to meet short-term obligations. And again, most important to a bank or a lender. And here's one you're going to want to look at. This is a current ratio, which is all current assets divided by current liabilities. So if you took current assets from the top or the left of the balance sheet, divide that by the current assets, which are on the right or the bottom, a 1.5 to 2 times, 1.5 or 2 to 1 is good for automotive repair, but the higher the better. And then you have quick ratio, which may not have the same impact as some because I know a lot use a lot less inventory today. But this one is current assets minus inventory divided by current liabilities. The difference here is we're minus an inventory from assets. But here, 2 to 1 is good, the higher is better. So there's definitely one that I want you to try to take a look at. It is simple math. Grab your cell phone, grab your balance sheet, test the waters, and see how you look to a bank. Then you have profitability ratios. And this indicates how efficiently a company generates profits for its value and or shareholders. And with shareholders, I'm talking about you. But higher ratio results are often more favorable and best when compared to similar companies. So what's this look like? First of all, you guys are familiar with this one. This you will get from a P&L But anyway, net profit, the bottom line dollar value after all expenses from gross divided by your revenue, your total sales. That is a net profit margin in that one. You saw mine. I said 20%. And we work with business owners to get anywhere from a 15 to 20% bottom line or a great return on their business. But then you have return on equity, which is a combination of a P&L and a balance sheet. The net profit comes from the same bottom line of the P&L. Divide that by shareholders' equity on the balance sheet, which is a line item. Shareholders' equity, owner's equity, and a good return. If you took the net profit dollars from the P&L, used for same time period, 12/31/2024, and a balance sheet as of 12/31/2024, and do that math, it'll give you your return on equity. And a good number here also is a 15 to 20% return. Then you have return on assets. And again, here we're using a P&L and a balance sheet. The P&L, year-end P&L, net profit dollar value, divided by total assets from the same period of a balance sheet as of 12/31/2024. Greater than 5% is good. A little closer to 7 to 10 is probably more average for the automotive repair industry, but over 20 is excellent. And there, right there, when you see it that high, we are very, very efficient in our pricing strategy, and this business is making money. And EBITDA value, we just talked about that, and hopefully you see its importance. But that EBITDA value averaged as a percentage 11 to 26%. 26% was really high producing shops. And I'm not talking about always in dollar revenue. I'm just talking about efficiency and pricing and dollars. So to give yourself a barometer, 11 to 26% is the range for automotive repair. Some of the top performing shops in the country are closer to 20% and above. Just food for thought there. And again, here's one that's not as easy always to do, but it is called a return on investment. And this comes from the balance sheet and P&L, because the formula for this, and I kind of said this to a degree already, except it's EBIT, earnings before interest and taxes, with no depreciation and amortization, divided by capital employed, or the money you have personally put into the business. According to bankers, 10 to 26% is good, but higher is better. So with that, hopefully there is some good information on liquidity and profitability ratios. And hopefully I've done my job and shared with you why you should look into this. Now I got two more. The third one is leverage ratios. And I kind of talked about this to a degree, but here's the ratios used. But this is about to what extent is a business using debt to pay for its operations and how easily it can cover the cost of that debt. Interest coverage ratios, debt to equity ratios, and debt to assets. And these are the kind of items that can tell you when is it time to go. But first, interest coverage. And this ratio assesses the margin of safety on a company's debt and how profits compared to its interest payments. And this one here, EBIT divided by interest expense, which really is earnings before interest and taxes, just like we talked about with EBITDA, but no D&A, and then divided by the actual interest expense. That number will tell you your interest coverage. And a great benchmark to shoot for, 2 times. Your EBITDA value is twice as much or better of your interest expense. Now, again, EBIT is net profit dollars from the P&L plus the interest and taxes. Why do you care? Bankers and lenders look at this closely, and your business needs profit substantially higher than its interest obligations. Then you have debt to equity. And again, this goes under the looking good to a bank. And this measure shows the extent to which a business is using borrowed money to enhance the return on owner's equity. Total liabilities from the balance sheet divided by owner's equity on the balance sheet. Debt to equity ratio. So in other words, you have better than 2 times or equity than liabilities, but closer to 0 is better. So 2 to 1 is good, but closer to 0 is better. So I'm sorry, total liabilities divided by the equity will give you your debt to equity ratio. Why is it important? Lenders focus on this ratio to determine whether a company is too highly leveraged. I did say it's okay to have some debt, but it may also be negative because here they're thinking that you may be too conservative in using debt to leverage or to generate profits. There is nothing wrong with debt. It just means that your equity needs to be worth more than the liabilities. Your business needs to be worth, you need to be worth more than the liabilities. Debt to assets, again, looking good to a bank. Here's your formula. Total liabilities from the balance sheet divided by equals debt to assets. 72% is average for repair shops, but lower is better. So when you go back and want to look and see where do you stand as far as looking good to a bank, these are 3 that you are really going to want to look at. Now, my last set of ratios that we're going to talk about is efficiency ratios. And this one's about how efficiently does a company use its assets. You got asset turnover. How effective is a company using its assets to generate cash? And this is a critical measure of a company's productivity. And this one is total revenue from the P&L divided by total assets from the balance sheet. A good asset turnover is 2.25 or better. So you are generating 2.25 times or 2.25 times more revenue than your assets. And inventory turnover, this one's really kind of all over the board these days because not a lot of people have a whole lot of inventory sitting on a shelf. The benefits of European specialists, Japanese, or specialized auto repair, there's where inventory is beneficial, but to an all makes, all models, not so much. And this one is more like a 2.5 times or better. And everybody's going to have a little something different as far as their perception of inventory turnover. Just inventory cannot be stale. Now, all of these balance sheet ratios, they're all very subjective to your profile. And that really is all about your risk profile, your risk appetite, and what type of a gambler are you. So I just wanted to share with you what comes from a balance sheet. Why do you care what it can tell you, but also what are some great industry averages and who are going to use these with you and or against you, unfortunately. Because I have seen very well run shops, very profitable shops on P&L